Hello, I'm Steve Balch from Certa Financial Planning. I'm the Director of Wealth Management and Financial Planning, here to give you our monthly market update for June. From a macro stance, we continue to be the same for now. We are watching to see if changes are needed. The market trend. After a brief setback in April, the markets have bounced back and continued their uptrend, closing at an all-time high to start the month. Fed policy. Fed policy continues to be neutral. After a weaker jobs report, the market is optimistic the Fed will shift and start cutting in September. These cuts would lead us to shift from a neutral stance to a positive stance. Fiscal policy continues to be a stimulus for the economy. With 2024 being an election year, both sides feel inclined to help voters, and spending continues to be strong from the government. Economic leading indicators continue to be a positive. Even though the job market is showing signs of slowing down, the question is this a seasonal adjustment with summer coming or an early signs of a recession? Time will tell. For now, consumers continue to spend, wages continue to be strong, and earnings continue to grow. Valuations. U.S. growth valuations continue to be stretched, while the rest of the world and other U.S. markets remain attractive. This balances out to a neutral stance. In the market regime, we continue to stay in a reflation regime. This regime happens when inflation and growth are both increasing at the same time. If inflation starts decreasing like we saw in last month, we will shift back to Goldilocks. This is still a risk-on regime though. Business cycle. The U.S. business cycle continues to stay in the late stages, but we have moved back in the stage as there have been signs of stabilization and even reacceleration in some areas. Recession risks continue to be moved back. 3 questions we're monitoring. A strong May, now what? When does bad news become bad again? Is everyone too pessimistic? After a volatile April, the market snapped back in May with one of the best Mays in 15 years, with a return of almost 5%. Historically, after a big May, June, which is usually not a good month, has seen a solid 1% return 8 of the past 10 strong Mays. Even better, the rest of the year was up more than 10% on average after a big May, more than double the average final 7 months of the year. Finally, the last 4 times we have seen large gains in May, 1997, 2003, 2009, and 2020, the market saw at least double-digit returns to finish the year. Let's hope that history repeats itself. When does bad news become bad again? After weak jobs reports, decreasing job openings, and softer inflation, the market is optimistic the Fed will start to cut rates this year, as bad news is good still. The market anticipates the first cuts to happen in September, and potentially a second cut in November or December now. For now, the market is hopeful softening data will lead to Fed cuts, but not a recession. With consumers continuing to spend and corporate profits continuing to grow, the idea is a softening stance on interest rates will help continue to fuel liquidity into the markets. The question we'll continue to watch is when does the bad news become bad and shake the market? That may be the sign that things are changing. A signal we'll be watching for is a move in the bond market, particularly a move in the 10-year Treasury below 4% with conviction. Is everyone too pessimistic? Now, there is bad news everywhere you look, with headlines continuing to be pessimistic. We constantly hear about consumers are struggling with prices, the economy is on the brink of recession, only a few stocks are actually doing well, and how the political and social unrest around the world is going to lead to World War III. Nevertheless, 2024 is one of the better starts to a year ever as stocks have gained double digits through May. Even better news, there could be more gains to come. Historically, when the market is up 10% or more through May, the rest of the year has been up 16 out of 19 times, with a solid 8.8% gain on average. Our positioning and outlook. After a strong May, our models have become more favorable on growth strategies, but we remain in a neutral stance. Historically, the next 3 months are the best 3 months of an election year. Currently, our internal research still sees summer seasonality playing out with volatility, which is weighing on our exposure. However, with our exposure to tactical strategies and their ability to move in and out of the markets, we are comfortable with our participation in any summer rallies. The only strategy we continue to underweight is preservation due to rising rates being a negative draw on fixed income performance. Our preservation strategies continue to focus on short-term fixed income and money markets for now. Overall, we see the market in a positive trend and believe the bull market has room to run. If our models continue to move favorably towards growth, as the chart suggests they may, we will look to adjust accordingly. We thank you for watching. As always, please feel free to forward this to anyone you believe that can benefit from the information. If you have any questions, please feel free to reach out. Thank you for watching and have a great day.